Hey, what's up guys, John here. Janet Yellen warned America that we're going to see a wave of regional bank consolidation in front of us. And this was 6 months ago.
More bank mergers are likely. That's what the U.S. Treasury Secretary tells the Wall Street Journal.
We're walking into this problem now as regional banks just reported massive losses on their loans. And when you look at how America is funded, how small businesses funded, how commercial real estate loans are funded, you'll see that a large block of that funding comes from these regional banks. And as these banks fall, so does America. Take a look at this. So 70% of all small business lending is done by smaller banks. This is across 95 countries. And this is according to Goldman Sachs. Goldman Sachs also reports that 80% of all bank loans for commercial properties come from regional banks. So when you walk into this massive problem that's been built up over the last couple of years, you're going to see a completely new lending standard. I mean, this is going to get pretty crazy, especially when you look at these new regulations that are happening at the same exact time that are putting even more weight on these regional banks.
A default on our debt would trigger an economic and financial catastrophe.
I'm going to break it down for you. I'm going to show you what to expect. Please hit the like button. When you hit the like button, you can share this content to educate more people about what's really going on. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com by clicking the link in the description to schedule a free strategy session. Take a look at this. So, bank reserve requirements 3 years ago were zero. So banks did not have to have the funds on hand. So they didn't have to have any of the deposited money in the bank, making for a flawed system. Then what you're starting to see here is what's going on just 2 days ago. So bad loans are becoming a real problem for regional banks. Office buildings in Southern California, a healthcare operator in the Northeast, a bankrupt oil and gas company in the Atlanta suburbs. These are among the assets that became the source of lending problems for regional banks in the third quarter as corporate borrowers in commercial real estate began to show more signs of strain. In recent weeks, many mid-sized financial institutions across the country reported that non-performing loans, a measure that tracks borrowers that are behind on their payments, rose during the third quarter. They disclosed mounting costs from unpaid debts and written off as losses. Look at this. Of 18 regional banks analyzed by Yahoo Finance with assets ranging from 50 to 250 billion, 15 of the 18 reported jumps in non-performing loans when compared to the same year ago. 15 out of 18 banks reported this. The average rise was 80% more than the third quarter of 2022 and 8% when compared to the second quarter of this year. Charge-offs, a measure of unpaid debts written off as losses, also rose at 15 of the 18 banks compared with the same year ago. Same period. Investors have been bracing for credit trends to weaken, but it's always theoretical, whereas now we're actually seeing it. We could have very well be at the beginning stage of a credit cycle. This is what's going to happen. We're going to start seeing credit conditions tighten up dramatically over the next 6 months, 12 months. Every month is going to get harder and harder and harder. The KBW, Nasdaq Bank Index, fell Friday by 2.3%, hitting the level last seen in September 2020 as worries mount of the future profitability of the industry. If interest rates remain elevated for some time, stocks and mid-sized regional banks have fallen more than giant institutions like Goldman or JP Morgan. So you start to see the trend that's happening here. They're already saying there's going to be losses for sure. Now, a steep decline in property values and rising interest rates make things even more challenging for borrowers as a lot of the debt comes due. There's a total of $331 billion in commercial multifamily mortgage debt set to mature in the next 2 months, right? So you're going to start to see this problem start to really hit these banks. Bankruptcy filings are already up 30%. There was 30%. Corporate bankruptcies in the U.S. rose 30% over the last 12 months. Record collapse. New report shows extent of regional bank pullback in commercial real estate lending. And look at this. So what this is NII, is the difference between the interest rate that the bank pays you for your deposit versus how much they can actually lend it out for. So that spread. And they said that the Federal Reserve has hiked key borrowing rates 11 times since March 2022 by a total of 5.25 percentage points, and central banks recently vowed to keep rates higher for longer to combat stubbornly persistent inflation. Higher rates could mean more losses on banks' bonds portfolio and contribute to funding pressures as institutions are forced to pay higher interest rates for deposits. Dallas-based Commercia issued a similar warning as regional, saying its NII is expected to decline between 5 and 6% in the fourth quarter. The bank reported a $106 million year-over-year decline as in NII to $601 million in the third quarter. So you're seeing the trends here, And they say several regional banks sizable drops in profit during the third quarter as they struggled with higher deposit costs, rising loan losses, a reminder that the stresses that roiled the industry in the spring are not over. So you have to ask yourself, what will be the impact of the student loan crisis now that deposits are going to continue to outflow to make good for all of these other bills, all of these other expenses? You're going to start seeing a lot more pressure put on these regional banks. And then this is all happening as well. Supermarket bank branches closing 7 times faster. But look at this. So these are the new regulations that no one is really talking about. But this is going to be so huge. It's going to be so important. It's going to restructure banking as we know it in America. So American banks with at least $100 billion in assets would be subject to new requirements, which makes them hold a layer of long-term debt to absorb losses in the event of government seizure, according to a joint notice from the Treasury Department, Office of Comptroller of the Currency, Federal Reserve, and Federal Deposit Insurance. So you think about this. Regional banks are the ones that are lending on commercial real estate. They're the ones lending on small business. What got decimated the last couple of years? Commercial real estate, office, and small business. A lot of these businesses are deemed non-essential. A lot of them had much higher operating costs. I mean, everything was higher. Wages were higher. Everything was more expensive. And so now you're starting to see a situation unfold where these small businesses are getting completely ravaged by the change that has ensued in this economy over the last couple of years. All of the changes in consumer trends of how people spend money, where they spend time, where they consume information, everything was moved onto the smartphone. Everything was moved onto the device. And because of this, it's been a very, very big uphill battle for a lot of these small businesses. But who's holding the risk? The regional banks. The steps are the regulators' response to regional banking crisis flared up in March, ultimately claiming 3 institutions and damning the earnings power of many others. In July, the agency released the first salvo of expected changes of sweeping set of proposals meant to heighten capital requirements and stabilize risk models for the industry. In the latest proposal, impacted lenders will have to maintain long-term debt levels equal to 3.5% of the average total asset or 6% of risk-weighted assets. So all these banks are now going to hold even more exposure, more risk, more loans, more debt. The requirements will create moderately higher funding costs for regional banks, the agency acknowledged. That could add to the industry's earnings pressure after all 3 major credit agencies have downgraded credit ratings at some of the lenders this year. Still, the industry will have 3 years to conform to the new rules once enacted, and many banks already hold acceptable forms of debt. Already, the regulators, they estimate that the regional banks already have roughly 75% of the debt that they'll ultimately need. Adding 25% of debt is a lot of debt. So you're going to start to see a lot of change across these regional banks. And this came out a couple days ago, or rather 2 weeks ago. CFPB and Justice Department issued joint statement cautioning financial institutions they may not use immigration status to illegally discriminate against credit applications. They say that the Consumer Financial Protection Bureau and Justice Department today issued a joint statement that reminds financial institutions that all credit applications are protected from discrimination on the basis of their national origin, race, and other characteristics covered by the Equal Credit Opportunity Act, regardless of their immigration status. The CFPB and the Justice Department are issuing the statement because consumers have reported being rejected for credit cards and other auto, student, and personal and equipment loans because of their immigration status, even when they have strong credit histories and ties to America and otherwise qualify to receive loans. Well, in New York City, for example, there was over 100,000 migrants that came into the city, and many of them initially were unable to work because they did not have legal working visas. So many of them were simply out of work. They weren't able to, obtain employment. And so if they were not able to obtain employment, how could one then be able to obtain the ability to take out a loan if you don't have a job to be able to repay back the loan? Right? So what we're going to start to see here is we're going to start to see likely a lot of change unfold. I think we're going to see banks walking into a lot of risk. And what banks are going to be the ones that are going to fail? Definitely not the too big to fail banks. Those banks, I believe, are going to get much, much, much bigger. The Goldman Sachs, the JP Morgans, the Wells Fargo, the Bank of America. These large banks, I think, are going to start to consolidate a lot of these smaller regional banks over the next, call it a year or so. And when you look at this, who are they going to lend money to? Do you think they're going to lend money to a commercial real estate operator? Probably not. Do you think they're going to lend money to small businesses for equipment? I don't think so. I think what we're going to start to see here is a lot of change unfold. And so if you are a small business owner, you're looking to maybe obtain funding, financing, you want to put yourself in the strongest position possible right now. And one way in which you could do that is make sure that you're out of high interest rate consumer debt. You're putting yourself into a position to where if you were a bank, you would want to lend you money. You're putting yourself into a spot to where you can pivot and move in this new economy, because I believe we are going to walk into this situation where we are going to see credit continue to really, really crunch. They say that all banks, all of the bank regulators are working with banks that have, concentrations of troubled real estate to work out. The Federal Reserve Chairman Jerome Powell said earlier this month, 1/3, there's one regional bank that highlighted some of its commercial real estate challenges in the third quarter was New York Community Bank, which saw soaring loans from $642 million. That's up 64% from last quarter, eight times as large as compared to a year ago. That surge came largely from two office-related loans, one in Syracuse and one in Manhattan. In Utah, Salt Lake-based Zion moved $64 million in loans this quarter to non-performing status. And then you have, this situation, San Francisco, for example, there was a deal, $350 million deal that sold for $68 million. $68 million, 300,000 square feet. Who's holding this debt? Regional banks. So you start to look at all these big deals that are now getting pulled from these regional banks. What I think is going to happen is we're going to see a consolidation of commercial properties. We're going to see a consolidation of wealth ensue throughout what's happening with regional banks. What do you think about this entire situation? Drop below, hit the like button, add me on IG, and if you want to fix your credit, we'd love to help position you for what I think is going to be one of the greatest wealth transfers of all time. Go to GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com by clicking the link in the description below this video, and I'll catch you in the next one.